If you've watched the movie The Social Network, you're probably aware of how Mark Zuckerberg and Eduardo Saverin changed the world with Facebook. Witnessing the growth of a social media giant is rare because there are so many ways for a social media company to fail. It's a harsh, it's a cutthroat, and it's an unforgiving industry. While Clubhouse still have plenty of time, their explosion into the limelight in their first year has been incredible. As the global pandemic forced the world to sit at home, many companies fell into tunnel vision, only seeing restrictions and limitations. However, a few companies saw an opportunity in what was, and still is, a drastically unique situation. Many companies such as Zoom and Houseparty utilized the unique market situation to expand their market share and explode onto the scene. Despite this, no explosion was quite as remarkable, fascinating and brilliant as Clubhouse's 8th-month trajectory from being a startup to a company valued at $1 billion. Welcome to our Clubhouse Masterclass. When researching into Clubhouse, I found there were 3 crucial aspects to their growth: influencer marketing, their strong ties to the Silicon Valley tech community, and their immaculately designed product. While I could delve into the importance of each aspect individually, I feel Clubhouse's rise to success is better explained in a chronological fashion. To say timing is important in the tech community would be to grossly underestimate it. Opportunities for growth, for investment, and for product development come and go. What's guaranteed today is a total uncertainty tomorrow. For every tech company in Silicon Valley, this principle is a non-negotiable. It's the difference between success and failure. Till today, Clubhouse have been impeccable in their timing and execution for such matters. As a result, I believe it's only fair that this video shines a light on that aspect. For those who are unaware, let's quickly touch upon what Clubhouse actually is. It's an audio-only social media app launched in April 2020 by Rohan Seth and Paul Davison. In the app, people have conversations in rooms about various topics from technology to culture to sports and many, many more. The invite-only strategy and open network layout is crucial to the success of the app, which I will delve into in more detail later on. First, let's delve into the first 2 months from April 2020 to May 2020 and find out why Clubhouse was such a massive hit in this period. It was down to the reputation and network possessed by the founders Rohan Seth and Paul Davison and how they used it to reach huge influencers. The first few months are some of the most important months for a tech startup. It's sink or swim time, really. Securing funding and securing a viable route to market are absolutely crucial. Let's start with the latter. Clubhouse reached their markets via the promotion of mega influencers such as Drake, Elon Musk, and Oprah Winfrey. Now, the only thing that I'd say is more likely to guarantee you success than influencer marketing would probably be a Ray Allen jump shot. No, in all seriousness, the endorsement of a huge influencer will at the very least draw a lot of attention to your product. Startup clothing brands have been launched into success after an endorsement from Kylie Jenner. Musicians have found themselves performing at Wireless after an endorsement from Drake, and comedians have found themselves at the Apollo after an endorsement from Kevin Hart. And so the list goes on and on. But here's the thing, these opportunities come few and far between, and the barriers to entry are ridiculously high. You'll find that mega influencers don't sell endorsements. That's just not how they operate. So the fact that Clubhouse found themselves with Drake, Oprah Winfrey and Elon Musk using their app within the first 2 months is not just strange or unusual, it's nothing short of remarkable. This party of mega influencers congregating is what essentially an app in its infancy stages drew attention not just from Silicon Valley but the whole world. Clubhouse were on the radar of all the social media giants, and it was all thanks to the network of Rohan Seth and Paul Davison. Seth and Davison are by no means new to the Silicon Valley scene. They have a strong standing reputation in the tech community with links to a lot of high net worth individuals in the tech and VC industries. The pair are responsible for no fewer than 4 successful tech startups. One startup in particular, Highlight, was purchased by the social media giant Pinterest. While I do believe it's too reductionist to put Clubhouse's success purely down to their network, there's no doubt that their ability to reach the aforementioned group of mega influencers in such a short time frame is thanks to the social standing and reach of their initial group of beta users. This network allowed them to market their beta version of Clubhouse with ease. By April 2020, they had quickly accumulated 5,000 beta users. It was the early stages, but Clubhouse were already gaining a lot of buzz from celebrities. As soon as Seth and Davison noticed the initial influx of celebrities into Clubhouse, they they had anticipated some exponential growth in their near future. For tech founders, this is both terrifying and also exciting. For the last thing they'd want to happen is Clubhouse's servers to crash due to inadequacy in relation to traffic. Once again, their ties to the tech and VC community came in handy, as they swiftly sought out a Series A funding from venture capitalist firm Andreessen Horowitz for a figure of $12 million. Securing investment from a company the size of AH Investments was an impressive coup for Clubhouse. AH Investments have a valuation of $14 billion. They manage up to 10 separate VC funds, and to put the icing on the cake, their specialty focus was in tech companies. Unlike other rash, last-minute Silicon Valley investments, this was a carefully crafted, bespoke investment which would go on to benefit Clubhouse in the months to come. To really appreciate Clubhouse's early success, you have to look at it in the wider context of Silicon Valley. For all the brilliant startups the tech capital produces, there's a lot of failed companies that we don't hear about. Silicon Valley tech startups tend to fail in the first year for the following reasons, such as having a lack of funding, having key investors pull out, and having the wrong people at the top of the company. Oftentimes, the personality, the ambition, and the general objectives of the founders aren't aligned, and this leads to a disjointed and divided company. These reasons occur all too often in Silicon Valley. Many companies find themselves without funding in key moments due to the risk-averse nature of venture capitalists. A company indicates they have bad financials, a poor product, or poor marketing strategy. Venture capitalists tend to avoid investing, and if they've already invested, they won't hesitate to pull out. The market between venture capitalists and startups is heavily favoured towards venture capitalists. Most Silicon Valley startups don't have high enough credit scores to secure bank loans, they don't have the awareness and reach to source crowdfunding, and they don't have the network and reputation to call upon multiple VC firms as options. As a result, the hopes and investment often hinges upon one VC firm, who will take advantage of their bargaining power to take a large share of the company at a discounted rate. So it's clear that the three factors which cause Silicon Valley tech startups to fail are the very same strengths that lie within Clubhouse. The network and reputation of their founders, combined with their brilliant invite-only strategy, was a highly effective route to market awareness and made Clubhouse a highly attractive and potentially lucrative investment opportunity. Moreover, their network also helped them secure investment from Andreessen Horowitz. When a company secures a sizable Series A funding from a large VC firm, it's safe to assume that they had multiple options on their table and had a lot of bargaining power during their negotiations. Let's move a little further down the timeline now, looking at Clubhouse's stability, momentum and consistency throughout June 2020 to December 2020. The stability is down to their foundation, which was their product, their service, or to put it in broader terms, the experience that they offer to their users. Without an immaculate UX and UI, otherwise known as user experience and user interface, any social media app would struggle to gain the approval of the wider community. Short-term buzz around a product is a common occurrence, but without a quality product, it would be highly difficult to maintain the same levels of engagement from the initial months in the long term. Just look at House Party. The app was a major hit during the first lockdown, but the buzz died off and people went back to using Twitter to find new people and Zoom to communicate via video. What really separated Clubhouse from its competitors is that their users don't need to look at a screen once they've chosen a conversation to tune into. This is hugely convenient for users as they can effectively use Clubhouse while on the go. It's pretty much like a live podcast. As a result, Clubhouse generates ridiculously high levels of screen time that are similar to Spotify. Clubhouse members can use the app while they're driving, while they're running, and even while they're sleeping. The app is always open and is always running. Apps that generate a lot of screen time are typically given higher rankings on Apple's App Store. As a result, they generate more downloads, which in turn makes them more attractive prospects for investors. Secondly, Clubhouse's app has an open network structure. This essentially means there's no restrictions. You can visit the areas you want and you can engage with the people that you want. In Clubhouse, you can drop in and out of rooms where conversations are happening. You can raise your hand and ask to speak and contribute to the conversation. You even have the ability to break off into smaller groups and have conversations about the bigger conversation. This is very much unlike Facebook's closed network, where others can only consume your content if you give them permission. It's also important to mention that Clubhouse's strategy to target a wide audience with a wide range of interests indicated that they'd learned from the mistakes of a previous audio-only app, Discord, which focused its content towards the gaming market and subsequently stagnated in growth after a few years. Conversations on Clubhouse are not saved or archived for later consumption, which means if you miss the live show, you're going to miss out. Or as Jim so eloquently puts it, at
things that if you didn't see them live, you wouldn't really care that you didn't see them at all.
As a result, when a celebrity announces that they're hosting a conversation on Clubhouse, it generates a lot of interest, and it even gets other influencers talking. This is a clever strategy by Clubhouse as it plays on people's natural fear of missing out, otherwise known as FOMO. The element of FOMO wasn't just in the app, but in the outreach strategy. Clubhouse was and still is operating on an invites-only basis. With celebrities hosting conversations and over 600,000 users on the app, it very much has the feel of an exclusive party. And for someone on the outside looking in, it has an air of mystery and allure, and inevitably leads to a sense of desperation to be involved. The exclusivity of a Clubhouse invite inevitably led to a monetary value being placed on it. Within a few months, Clubhouse members began selling their limited invites to eager and anxious users in the waiting line. While it's difficult to ascertain whether Clubhouse's growth might have been different if they had operated on an open scheme like Twitter and Instagram, it's safe to say that the reputation and value of their product is a lot higher than it would have been on an open scheme, and that's thanks to the element of exclusivity. To summarize the April to December period, Clubhouse had created an immaculate app centered around exclusivity. This invite-only method only created more mystery and attraction to their app. Their ties to the tech community allowed them to quickly reach the influencer community, which sparked their growth. Their brilliant product allowed them to build upon their community of mega influencers and reach a wider audience, which allowed them to grow from 100,000 users in June 2020 to 600,000 users in December 2020. Their ability to find influencers, secure funding, and maintain momentum was always going to be the three main blocks to overcome. And they did overcome all obstacles in the most timely fashion. One can only assume that the experience of founding other tech companies has prepared Seth and Davison for this moment. To tie it all together, let's look at Clubhouse's big January in 2021. It was a transitional month for Clubhouse as they were in a rather precarious position. 600,000 users were currently on the app. Mega influencers as well as micro influencers were becoming more and more important for the traffic generated on the app. And most importantly, they were still without any significant Series B funding. Despite these dangerous indicators of failure, Seth and Davison brilliantly navigated Clubhouse through this position. Clubhouse navigated through this stormy weather by focusing on one simple thing: not making the same mistakes as their predecessors. To explain this, I need to give you all a quick history lesson. Anyone remember Vine? Well, it's cool if you haven't, but if you ever watched a hilarious 7-second clip from 2013 to 2016, it was probably from Vine. Vine were booming. They had an amazing selection of influencers, which included YouTube sensations Jake and Logan Paul, as well as David Dobrik. These influencers were bringing in more and more people to the app. And here's the thing, these influencers were acutely aware of the power that they held. They demanded that Vine should be compensating them for their services. And considering these influencers were holding up Vine's success, it was only fair that they demanded a sum of $1.2 million, which Vine had promptly rejected, just as they'd rejected any other monetization opportunities from other brands. While avoiding advertisements is understandable, not paying your influencers is a completely separate matter. While the principles and the culture of Vine were important to the founders, it was ultimately their downfall, as their refusal to monetize meant that influencers moved their content to other platforms, namely YouTube, where they grew their fan base and monetized their content. Clubhouse made no such mistake. They secured a massive Series B funding from Andreessen Horowitz and have used this influx of capital to launch their creator program. This program allowed them to compensate their most popular influencers as well as their emerging influencers based on the amount of traffic they bring to the app. Rumours have also swirled about a subscription platform where users can pay to subscribe to their favourite content creators. This was a big move from Clubhouse. They secured the long-term future of the app by ensuring that influencers feel valued for their services and have ensured they're staying in for the long haul. This is a proven method of success shown by YouTube and TikTok, who both prioritize the monetization of their influencers' content. Clubhouse have also used this investment in other areas, notably their focus on widening their target audience even further by investing into the development of an Android app and adding accessibility and localization features so Clubhouse can target new markets with better efficiency. This will ensure that their growth will not stagnate. By using this investment to make it easier for new markets to access Clubhouse, we can expect their membership levels crossing the 1 million mark in the next few months. To add to that, securing their existing user base with a creator program, Clubhouse have effectively killed two birds with one stone and have secured the long-term success of the company. In the first year as a company, Clubhouse have laid the foundations for success. They've achieved this with their clever use of influencer marketing and now with their targeting of new markets. For the coming year, Clubhouse face a challenge in ensuring the creator program runs smoothly, ensuring the app is fine-tuned and balanced between monetization and the enjoyment of their general user base, and finally ensuring that they successfully grow their platform to a truly global audience. Thank you so much for watching. I hope you enjoyed the watch. I know I enjoyed making this video for you. Please remember to like, share and subscribe, and stay tuned for my next video, which is on Nike's pioneering use of influencer marketing with Michael Jordan.